In building wealth, the first $100,000 is the most challenging. It may seem slow at the start, with small yearly gains making you consider giving up for a steady paycheck. But as your savings grow, they start to multiply, pushing you to that $100,000 goal faster than you'd think. Your money grows and you reach the $1 million mark sooner than you ever imagined. So, join us as we delve deep into the art of saving, revealing a step-by-step guide that will help you amass your first $100,000 at lightning speed. But before we get right to it, make sure to subscribe to the channel and give this video a like. Also, make sure to pay close attention to the final step, as it's guaranteed to significantly boost your savings. Now, let's dive right in. Step 1. Supercharge your savings with smart planning. Did you know that your tax plan can dramatically impact your financial life? Taxes can take a big bite out of your hard-earned money, but there's a way to make it easier. Imagine having the ability to lower your tax bill. It's possible. When you contribute to an individual retirement account or a 401k, you're giving yourself a tax break. This means you get to keep more of your money, like a turbo boost for your savings. Here's the secret. When you invest in these accounts, you don't pay taxes on the money you put in. It's a shortcut to reaching your financial goals faster and hitting that magical $100,000 mark sooner. But there's more. Your savings grow without the burden of immediate taxes. How about earning $50,000 in a year, saving $10,000 in a 401k, and watching your taxable income drop to $40,000? Pretty cool, right? In 2023, you can put away up to $20,500 in a 401k and $6,000 in an IRA. That's a significant sum to reduce your taxable income. And don't forget about Roth IRAs, they offer rapid savings growth. If you want to make your financial journey more exciting and rewarding, explore tax-advantaged accounts. It's like giving your money superpowers. Step 2. Boost your earnings for smarter investments. It's no secret that the simplest way to grow your savings and invest more is by increasing your income. While being thrifty can only take you so far, your earning potential has no defined limits. That is like embarking on a side hustle to supercharge your earnings, specifically earmarked for your investment goals. The opportunities to kickstart your own small business are boundless, and many of them offer flexibility that fits into your schedule. Whether it's dedicating a few hours on weeknights or weekends, a side hustle can dramatically amplify your savings potential. By bolstering your income instead of just trimming expenses, you can effortlessly fund your investments without disrupting your day-to-day life. This strategy is paramount because it ensures you remain on track with your financial goals, all without feeling like you're missing out on life's pleasures. Step 3. Reinvest dividends. Imagine you start to see some extra money flowing into your bank account, and all you did was own a piece of a company. It's like a little reward, a pat on the back for your investment. You might be tempted to splurge on a fancy meal or start planning your dream vacation. People really love these little cash gifts known as dividends. They can feel like a sweet bonus. But here's the thing. Don't forget your financial goals when you're deciding what to do with this newfound money. One of the smartest moves you can make to supercharge your stock market gains is to reinvest those dividends instead of just pocketing the cash. We know it's tempting to treat yourself to something fun, but trust us, funneling those payments right back into the same stock or fund that gave them to you is often the winning strategy. Let's check out how this strategy can turbocharge your returns using the example of the S&P 500. Over the last century, this index has averaged a solid 10.7% return when dividends were reinvested. But if you had chosen to skip reinvestment and just took the cash, your average return would have been a measly 6.6% according to wealthycorner.com. That's a substantial difference in your financial journey. Step 4. Invest smarter, not harder. When you're on the journey to your first $100,000, it's crucial to be mindful of how much you spend on your investments. The fees associated with your investments generally come in two forms: commission fees for making trades and expense ratios for index funds and ETFs. In the past, it was common for brokers to charge you a fee every time you made an investment. However, thanks to newer, more cost-effective options, trading is now mostly fee-free. But keep in mind that companies still have expense ratios, and these can vary. Think of an expense ratio as an annual cost you'll incur for owning an index fund or ETF. These funds, which track the performance of benchmarks like the S&P 500, are essentially the same across different companies. Since they are equal in product quality, your best bet is to select the most cost-efficient option. For instance, Fidelity's S&P 500 fund charges an expend ratio of 0.09% of your total investment, while Vanguard's equivalent S&P 500 fund charges only 0.03% of your total investment. By making this choice wisely, you can optimize your investments and keep more of your hard-earned money. Step 5. Stay calm amidst market turbulence. It can be quite scary when the value of your investment starts to drop. You might find yourself questioning if the market will ever bounce back. What if, when the market takes a dip, you decide to sell everything in an attempt to limit your losses? The idea of selling at the market's peak and then buying back when it's at its lowest sounds like a brilliant way to secure profits and grab discounted deals. However, pulling this off successfully is extremely challenging. Typically, everyday investors who have tried this approach in the past end up missing out on most of the profit because they don't buy back in until it's too late. When you're working towards your first $100,000, don't fret over how the market is performing on a day-to-day basis. Sometimes it will reward you with significant returns, while other times you might see your investments in the red. Instead of obsessively managing your investments and getting stressed about every market twist and turn, concentrate on saving as much money as you can and riding out the market's ups and downs for the long term. Step 6. Choose the perfect investments. Neglecting smart investments could cost you a lot of money, missing chances to grow your wealth. If you are new to investing, your main goal should be to make your money grow. Surprisingly, many people start investing without really understanding what they're doing, especially with a 401k. Yes, high returns often mean higher risks, but if you're investing a small amount, will it really change your life if it doesn't go well? Still, don't be careless with your money by gambling on risky stocks or cryptocurrencies. Focus on growth instead. Unlike those close to retirement with big savings, your aim is to make a good profit by spreading your money across different investments. A great strategy is to invest in a fund that copies the S&P 500. This way, you'll benefit from the success of companies like Apple and Amazon, owning a piece of around 500 different stocks in different industries. Or you could choose an S&P 500 growth fund, which does the same but really hones in on potential growth. These options can lead you to financial success. Step 7. Dodge the lifestyle inflation trap. Avoiding lifestyle inflation is a crucial step towards financial success. It's the trap where you start spending more just because you earn more, and it's a surefire way to stay stuck in a cycle of financial struggle. Did you know that most millionaires save a whopping 64% of their income? It's a fact. When people start making more money, there's a natural temptation to upgrade their lifestyle. Suddenly, they feel entitled to a fancier car and dining at posh restaurants. The problem is that spending tends to keep pace with earnings. If you fall into this trap, you'll find yourself forever struggling with your finances and little hope of improving your situation. So, here's a better approach. Whenever you get a raise, resist the urge to splurge it all. Instead, save most of it. This is especially important when your savings are still small because the bulk of your wealth won't come from interest. It'll come from the money you put in yourself. This simple habit is a major reason why the wealthy keep getting wealthier. Step 8. Tame the housing expense beast. Transforming your financial journey can start with a simple yet powerful move: slashing your housing expenses. For most folks, housing stands as the heavyweight champion of their spending, gobbling up a lion's share of their income. After forking over rent or mortgage payments, along with utility and other related bills, it can feel like there's barely a dime left to spare. Even if there is, it's hardly enough to make a dent when your goal is reaching that elusive $100,000 mark. But fret not, housing doesn't have to be the budget buster it often is. It's time to consider ways to trim or even eliminate this hefty cost, at least temporarily, as you embark on your journey to building a financial portfolio. There's a treasure trove of strategies at your disposal: bunking with roommates for some cost sharing, crashing at a friend or family member's place in a mutually beneficial setup, or relocating to a more budget-friendly area. And don't discount the power of house hacking. It's more accessible than you might think. When you carve out room in your budget by taming your housing expenses, you'll be astonished at the surplus cash you'll find at the end of each month. This stash can be your secret weapon in your quest to reach that coveted $100,000 milestone. Starting your investment journey might feel daunting, but fear not. There's a plethora of actions you can take to speedily sail towards that magical six-figure mark. By adopting these habits early on, you'll set yourself on a path to continuous wealth creation, where your financial worries will gradually fade into obscurity. Let us know in the comments which strategy you are using to increase your income for smarter investments. I'll see you in our next video.